Lately, I've seen a wave of videos claiming that taxable accounts are the most underrated retirement account, even going as far to say you should fund these in lieu of your 401k. And look, there's a reason that this message resonates. A taxable account is flexible and it does have some clear benefits. But today I want to show you some eye-opening math that might make you rethink prioritizing this account over the other options that you have. Because the flexibility of a taxable account comes with a cost that most people never calculate. So let's zoom out for a second. When you're saving for retirement, what options do you really have? You've got three tax buckets, each with their own benefits and drawbacks. The tax-free bucket, your Roth accounts, the tax-deferred bucket, things like traditional IRAs and 401ks. And then we have the taxable account, which is really where this debate starts. Now, I just finished a 3-part series on how to use these buckets once you're already retired. So if you haven't seen that yet, I'll link it below. But in this video, we're going to focus on the building phase, where you save, where you invest, and where subtle tax differences can quietly compound into hundreds of thousands of dollars over time. Let's start by looking at what actually makes the taxable account so appealing in the first place, and then we'll peel back some layers. So here's the case that's being made for the taxable account, and some advisors are referring to this account as a superhero account. First, it has no required minimum distributions. You're in full control. You decide when, how much, and even if you want to touch the money within this account. This feels like a clear advantage over IRAs, which at some point will force withdrawals. Second, there's no age restriction. You can access the money at any time without worrying about the 59.5-year rule or early withdrawal penalties. For early retirees or investors who want liquidity, this is a big deal. Third, the tax rates look better on paper. Long-term capital gains are capped and are lower than ordinary income tax rates at every income level. And finally, your heirs receive a step-up in basis when you pass away, meaning that when you pass that money on to the next generation, any taxes embedded within this account are eliminated. Now, these are certainly strong points in favor of the taxable account, and they sound almost too good to ignore. But in general, I have a problem anytime a case for a retirement strategy is made just off general bullet points. With any strategy that has trade-offs, just showing the benefit leaves out half of the equation. So next, I want to show you 5 hidden drawbacks to taxable accounts that can outweigh all of the benefits. So let's first talk about contribution taxes. The biggest benefit with retirement accounts, Roth or traditional IRAs, is that you are only taxed once, either on contribution or on withdrawals. With taxable accounts, you're taxed 3 times, on contributions, on growth, and then as well on withdrawals. We know this is problematic because taxes are the #1 eroder of wealth. But let's just put data to the test and see how much of a tax drag this triple taxation can have. Within this table, I'm using a 30-year time horizon that is meant to mimic the accumulation phase. We're going to be looking at contributing $15,000 per year with a taxable account versus a tax-deferred account. In addition, I'll just talk through what a Roth would look like as a third comparison. The other assumptions we are using are posted on the screen. With a traditional account, your full $15,000 contribution will go into this account because this contribution is tax deductible. With a taxable account and Roth, you have to pay taxes first, which means your contribution will obviously be less, $11,700 in this case. Now, with a Roth, you'll never owe taxes again. But with a taxable account, your contributions total up to equal something called a cost basis. This is money that you won't be taxed on again, but any growth that you have on top of that will eventually be taxed again unless you pass it on to the next generation. So as we follow this table to year 30, you'll notice the tax-deferred account obviously accumulates more wealth because those contributions are larger. In both cases, taxes will be owed when we start to withdraw. So as of right now, the year 30 balances are sort of a mirage. The taxable account investor doesn't really have $1 million here, and the 401k investor doesn't really have $1.3 million. So in the next step, we reduce the taxable account balance by the long-term capital gain rate of 15%, and we reduce the IRA balance by that higher ordinary income rate of 22%. Despite the traditional account seeing a higher tax rate on withdrawal, we see the traditional account comes out way ahead, almost a $100,000 difference. If we put this in after-tax return terms, the tax benefits of a retirement account come out around 0.5% per year higher than the taxable account. With a Roth IRA, you'd see the exact same total as the traditional IRA. You would pay a 22% tax on contribution, but then never pay tax on withdrawals, which would give you that same $1 million after-tax number. But the tax drags on a taxable account don't stop here. We have to look at the full picture. This brings us to drawback number 2, taxes during growth. When investing in a taxable account, anytime that you receive dividends, interest, or you make a change like rebalancing your account, you create a taxable event where the IRS is going to skim some tax dollars off the top. On the screen, I have an example of the effect that this can have. We're using an interest-bearing asset in this example. So you have a $1 million account invested in all corporate bonds generating 5% interest. The interest is going to be the same whether you have this bond in a taxable account or in an IRA, but remember, interest in a taxable account creates a taxable event. You pay ordinary income rates on interest, which is 22% in this example. When all is said and done, you end up with less compounding for your future inside of that taxable account versus inside of the traditional IRA. Next year, you're going to earn another 5%, but now the total interest is less within that taxable account. And once again, you will have taxes dragging down that same compounding. The same thing happens with dividends, but generally to a smaller extent because first, dividend payouts are generally less than interest. And number two, dividends are taxed at generally long-term capital gains if they are qualified dividends. But let's go ahead and update the table that we're using before to capture this growth drag. Within this example, we are assuming this is an all-stock portfolio. So we're going to be assuming a nominal 2% dividend rate. What is the effect of this dividend drag on the side-by-side comparison? Well, the traditional 401k numbers look exactly the same because contribution and growth taxes are all deferred. The Roth numbers would also look the same. But within the taxable account, we see the after-tax balance lower by another $20,000. The gap in after-tax return compared to the tax-deferred account now lowers by 0.7% per year. Now, even here, we're still not done with the side-by-side comparison and factoring in tax tricks. After all, I'm just showing 30 years of accumulating wealth. I now want to take the side-by-side and take the comparison into retirement. After all, one of the stated benefits of a taxable account over a tax-deferred account is the lower tax rate on withdrawals. And we can use a real-world client scenario to further the realism within our examples. So here's the scenario. We have a single retiree who is facing a 30-year retirement. They have Social Security income, pension income, and they need a total of $90,000 net of taxes. Now, we know the tax rate is going to be higher in withdrawing from this tax-deferred account. I worked out all of the math as to what this retiree would need to take from a tax-deferred account to meet their needs as well as from a taxable account. Total taxes from a tax-deferred account would be $9,000 higher. So they would need to take $54,000 per year, whereas the taxable account investor would only need to take $45,000. Now, note that before we were using a flat 15% tax rate on the taxable account and a flat 22% tax rate on withdrawals from the IRA. If we dig into the actual numbers, we actually see the effective tax rate on our IRA withdrawals would be higher than 22%, clocking in at 25%. And the effective tax rate on our capital gains would be lower than we previously expected, clocking in at only 10%. Despite this, we see that the lower withdrawal rates on a taxable account cannot overcome the tax deferral benefits the IRA or 401k provides. In year 60, the final year of life, there's about $2.2 million left in the taxable account and $3.6 million left in the 401k. Now, to be completely fair, I did not include all of the effects that RMDs or the various costs RMDs can have. For instance, this retiree would be forced to take larger than $54,000 withdrawals based on their RMDs. However, I also didn't include Roth conversions or other tax reduction strategies in here. And the gap between these two accounts is so large that you could suffer a lot of pain from RMDs and still come out way ahead with the traditional IRA. If we look at the value between these two accounts at death, the taxable account would receive a step up in basis. So their heirs would inherit that full $2.2 million with no additional taxes owed. The heirs of the $3.6 million IRA would still owe taxes on withdrawals. But in this example, they would come out ahead unless their tax rate on withdrawals was over 38%. So again, the tax drags that taxable account owners are subject to seem to trump the stated benefits earlier, like stepped up basis, lower taxes on withdrawals, and more. I think one of the biggest challenges investors have when analyzing past decisions is that there's no clear benchmark for what could have been. Let's say someone builds $1.5 million taxable account because they choose to invest there instead of maxing out their 401k. On paper, this still looks like a huge success. Most people would say at that number, hey, I did great. But what they can't see is the invisible comparison, the alternate universe where that same savings went into that tax-deferred account instead. In that case, maybe their balance isn't $1.5 million, maybe it's closer to $2 million. The problem is financial markets are so powerful that even non-optimal financial decisions can produce still impressive results, which makes it easy to mistake growth for efficiency or optimal. Now, I have a few more drawbacks related to taxable accounts that most people don't readily consider, but before that, just a quick aside. Since joining Merit, our team has been able to expand capacity and lower our minimums for viewers of this channel. If you're interested in exploring working with us, use the link or phone number in the description below and mention that you've been watching our YouTube channel. If you call Merit's mainline or fill out a general form, you might be paired with a different advisor who may not share our same philosophies or may even charge higher fees. Using this link ensures you connect directly with our team. Now, back to your regularly scheduled program. Drawback number 3 is one you won't hear talked about often, but is a real behavioral constraint that we see with clients with taxable accounts. So I've already told you that anytime you make a change within a taxable account, you create a taxable event, and that will slow compounding. So naturally, investors are going to have a built-in resistance to making changes. Let me give you an example. Let's say that we have an investor in 2020 that invested their taxable account in a fresh new allocation with 49% invested in a broad value stock ETF, 49% invested in a broad growth stock ETF, and then 2% was invested in a single stock. For most investors that pick a stock here or there, I often see they do so in their taxable account for whatever reason. Now, we don't want to rebalance regularly because of that tax effect, but the problem with this is allocations can drift very quickly. Now, I kind of cherry picked a stock that has grown substantially, but the overall premise here still applies. 5 years from this initial allocation, 20% of our taxable account is in that single stock. 47% is in growth stocks, and 33% is left in value stocks. Now, if I came to you fresh and asked, hey, is this the overall allocation that we would invest in if we had complete freedom to adjust things today? Almost no one would say, yes, I want 20% in a single stock and only a third invested in value stocks. Yet this is what we ended up with. Easy enough. Okay, well, can't we just rebalance? And the answer is yes, but remember that will affect compounding. And so we have two decisions here. We can just let things ride. However, that is likely to cost us overall growth unless we happen to get lucky. Or we can rebalance and guarantee that we slow compounding. A lot of investors get stuck here because the best decision isn't certain. So let's go back to our initial 30-year accumulation comparison, and let's just show the effect of rebalancing just once in this 30-year period. We're showing a full rebalance in year 15 here. Notice by the end of these 30 years, we end up with another $10,000 less than the last comparison that we had. The after-tax return lowers to 4.04% per year now. Now, one can make the case in this example that they could do some rebalancing with additional contributions, which is true. But the overarching point is that within a 30 or 60-year investing career, you will likely need to rebalance multiple times, and each time you do so, you are hurting the after-tax growth in your taxable account. Drawback number 4, I don't have a visual for, but it's another behavioral constraint. One of the biggest benefits of a taxable account is that it's accessible at any age. This is fantastic. But for some investors, liquidity can be a bug, not a feature. Easy access can lead to easy temptation. Think about it this way. Let's say that you are trying to lose weight and sweets are your guilty pleasure. Are you going to be more successful in avoiding sweets if you have them in the cupboard and are just going to rely on your pure discipline to avoid those sweets? Or will you have more success if you just fully eliminate every sweet from your house so you don't even have the option to break your diet? Well, obviously the second is going to be more successful, right? The same is true with a taxable account. I've seen many investors that are on a great pace to accumulate wealth and reach their retirement goals sooner than expected. But then they get tripped up because they find something that they just need to have, maybe a new car, boat, or even a house. They can't generally take money from their IRAs because of age restrictions, but they can take this money from their taxable account and oftentimes do so. Now, I'm not saying this is all bad. At the end of the day, money is meant to be used, and our goal isn't endless accumulation. But that new boat at age 40 might cost them 2 or 3 years worth of retirement income at age 60. And people aren't readily thinking about things in those terms when they make those impulsive decisions. So access can sometimes be a bug, not a feature. Drawback number 5 is creditor protections. Now, hopefully this is an issue most families never have to worry about, but some certainly will. When you save money in retirement plans, there are often creditor protections to varying degrees. 401ks are the most protected accounts, shielding these assets from creditors or civil judgments. IRAs don't have the same protections, but they do have some protections in cases of bankruptcy. Taxable accounts, on the other hand, have next to no protections. They can be seized, frozen, or garnished in the event of bankruptcy, lawsuits, or if you default on personal loans. Now, within all of this, it might sound like I'm really negative on taxable accounts. Far from it. Many high net worth investors will be forced to contribute to taxable accounts because they're simply maxing out all of their qualified accounts. As I'll talk about in a second, there are also certain circumstances where it will make sense to contribute to a taxable account even if you haven't yet maxed out those retirement accounts. The point that I'm trying to make in this video is that this is not some superhero account that you should greatly prioritize before your other options. All of the benefits of a taxable account come with a pretty significant cost, as we showed in after-tax return terms. A taxable account is often an account you are forced to contribute to because you are saving so much for retirement, or it's an account that we want to contribute to solely for those special events. Let me give you some examples of these special events and where it might make sense. The most common case is for those that are retiring early. Take this hypothetical situation for someone aged 50. Based on their overall situation, let's say this person can afford to retire with around $3 million in total assets. The problem this retiree will run into is that too much of their money is locked up in those retirement accounts that have restrictions until 59 and a half. This retiree might be able to retire based on their wealth, but can't based on their liquidity. Here, a taxable account can provide some real benefits. And so as you are accumulating wealth, it's important to ask the question, what goal am I building towards? If someone loves their career and plans to work into their 60s, contributing a ton into taxable accounts won't be optimal because they plan to retire on a more normal timeline. However, if you know you are working heavily towards early retirement, if the numbers end up working out in your favor, then certainly liquidity will be a focus. Most investors will be best served by using traditional or Roth accounts early in their career, and if early retirement becomes reasonable based on their numbers, opening up that liquidity bucket later in life. Let the compounding benefits of retirement accounts work in your favor early. It's also worth mentioning that there are legitimate ways to access retirement accounts before 59 and a half. For 401ks, the rule of 55 allows early access to your 401k if you retire in or after the year you turn 55. The 59 and a half year rule effectively turns into the 55-year rule. If you contribute to a Roth IRA, those contributions are accessible at any point in life. The growth might not be, but the contributions are fully accessible. If you plan far enough in advance, 5 years in this case, you can convert dollars from your traditional IRA into Roth IRA and access that conversion after waiting 5 years if you are younger than 59 and a half. Then lastly, you have something called a 72T, which will allow access to your retirement accounts before 59 and a half. It basically lets you set up a fixed withdrawal schedule calculated using IRS formulas that you have to stick to for at least 5 years or until you turn 59 and a half, whichever is longer. It's not flexible, but can be a powerful bridge for early retirees who need consistent income before traditional retirement age. And so again, the flexibility of a taxable account for early retirees is certainly a real benefit, but not the only option you have. And lastly, a taxable account can make some sense for special events as well, like planning for the Affordable Care Act marketplace. When on ACA insurance, the amount you pay for insurance is tied directly to the income that you report to the IRS. Every dollar of income you take from your tax-deferred accounts is counted against you dollar for dollar. But with a taxable account, just the capital gains count against you. Well, you might have a position in your account that has a $50,000 cost basis and $50,000 of unrealized gains. If you sell that position for retirement income, you will have $100,000 of spending, but just $50,000 will count towards your reported income for ACA purposes. So a taxable account can certainly be beneficial in circumstances like this. However, keep in mind a Roth withdrawal doesn't count against you at all. So if we have the space and are willing to pay taxes on contributions, Roths will always be better than a taxable account. Again, taxable accounts can be beneficial and certainly do have their advantages, but you need to acutely be aware of their costs. They're far from being the best account for retirement, as hopefully I've made it clear in this video. The truth is there's no superhero account. The power comes from how each account works together inside of your retirement plan and how that plan builds towards your goals, your income, and your tax future. If you want help building that kind of coordinated plan, one that uses each account to its fullest potential, that's exactly what our team does every day. You can reach out through the link in the description below or give us a call. Because remember, you don't need more money, you need a better plan. I look forward to seeing you in the next video.